The company vanished. How did this happen? Washington Mutual entered the crisis as one of the largest financial institutions in the United States. By September 2008, it reported roughly $307 billion in assets and operated more than 2,000 branches nationwide. Its risky decision was to pivot, aggressively, into option arms and low documentation mortgages. The clear consequence was regulatory seizure and a sale of its banking operations to JPMorgan Chase. The rise began as a classic growth story. A regional thrift became a national lender over decades. Balance sheets swelled. Branch maps radiated outward. Public filings show a steady climb in originations and fee income through the early 2000s. Management framed growth as strategic. Investors rewarded volume. Compensation plans rewarded loan production. The decision changed everything. Executives chose volume over restraint. The institution rewired pay and promotion to prioritize origination. Option arms, loans that allowed low initial payments with deferred principal or negative amortization, became a central product. Underwriting moved toward low documentation approvals and automated exceptions. Securitization markets absorbed loans. Management treated risk control as a bottleneck. Compliance and risk teams were increasingly asked to clear paperwork rather than to veto bad loans. The speed bump became a nuisance. Risk managers were asked to minimize friction, not to stop the train. Momentum followed. Originations accelerated. Loan officers saw approval rates climb. Branch openings were celebrated. Advertising promised fast answers and flexible products. Home buyers and brokers found a willing lender. On the books, the composition of the mortgage portfolio shifted toward non-prime and adjustable rate products with payment resets. Aggregated numbers in investor presentations show rapid growth in option arm originations and in loans originated for sale into securitizations. Warning signs emerged and then multiplied. Delinquency metrics edged up. Charge-offs rose in specific pools tied to option arms. Financial statements showed growing reliance on short-term funding and on securitization buyers to shoulder credit risk. Internal credit reviews recorded higher incidence of documentation gaps and underwriting exceptions. Analysts pointed to concentrated exposure to complex mortgage products. Credit rating agencies began to narrow liquidity windows. Capital buffers thinned relative to the characteristics of the loans on the balance sheet. Small losses arrived first. Localized spikes in defaults hit certain regions. Some pools of option arms required incremental reserves. Quarterly profits eroded. Management recalculated and kept lending. A larger loss followed. Families who had counted on low teaser payments felt payment shocks when rates reset. Foreclosures rose in communities where WAMU had been a major lender. Loan officers reported pressure to rework loans, to delay charge-offs, and to classify problem accounts in ways that reduced immediate hits to earnings. Reputational damage grew where customers felt abandoned after initial promises. Major loss came when capital markets turned. The market value of mortgage-backed securities dropped sharply. Washington Mutual recorded write-downs tied to these securities and to loans held for investment. Its short-term funding sources contracted. Credit rating downgrades reduced the availability of liquidity. The balance sheet suffered from a mismatch. Long-term risky mortgages funded in part by short-term wholesale borrowing and by securitization markets that could freeze. The crisis phase accelerated fast. Depositors, spooked by headlines and by deteriorating mortgage values, began to withdraw funds. Interbank lending and commercial paper windows narrowed. Regulators observed a classic liquidity run. On September 25, 2008, the Office of Thrift Supervision seized Washington Mutual and placed it into receivership with the Federal Deposit Insurance Corporation. The FDIC sold the banking operations and most deposits to JPMorgan Chase for $1.9 billion. Shareholders were effectively wiped out. The institution that had promised safety and community roots lost its chartered banking footprint overnight. The human toll unfolded in parallel. bank employees learned their fate between regulatory notices and auction results. Thousands of jobs were affected. Homeowners who had been approved quickly found themselves facing payment increases and, in many cases, foreclosure. Local community relationships, long-term lending ties between branches and small businesses, were severed or transferred. Small savers who relied on branch access saw familiar names replaced overnight. Executives who led the growth era saw reputations collapse. Shareholders saw market value evaporate. Forensic economics shows the mechanism clearly. Incentives drove product mix. Compensation tied to originations shifted marginal decisions across thousands of employees. Risk functions were recast as operational checkpoints rather than independent guardrails. The bank's business model relied heavily on selling loans into securitizations and on the continued availability of short-term funding. When those two markets closed, the model collapsed. The speed bump risk model, treating compliance as a drag rather than a controller of downside, turned predictable losses into a systemic failure. Prior episodes contributed to this failure. Growth through acquisitions and through widening retail footprints brought scale. Management choices after each acquisition favored integrating origination targets over harmonizing conservative underwriting cultures. Those earlier decisions left the institution structurally exposed when underwriting loosened. Investigations and litigation followed. Lawsuits by shareholders and by investors alleged misstatements and failures in disclosure about the quality of the mortgage portfolio. Regulators and congressional hearings examined underwriting practices, compensation structures, and the oversight provided by boards. The failure of a bank with hundreds of billions in assets renewed scrutiny of how large depositories managed liquidity risk and how governance structures escalated or muted warnings from risk teams. Policy consequences arrived too. The seizure of Washington Mutual occurred amid a broader financial panic that produced emergency interventions across the system. Legislative and regulatory reforms after the crisis, including changes to capital and liquidity requirements and to consumer mortgage protections, aimed to reduce the odds of a repeat. Dodd-Frank and new supervisory regimes expanded oversight of systemic institutions and reshaped expectations for risk governance. But those reforms came after the costs were paid by homeowners, employees, and investors. Along the way, specific decisions mattered. Management choices to expand, option arm production to lower documentation thresholds, and to realign pay to volume were direct levers that increased risk. So did the decision to fund a large portion of loan growth through the short-term money markets and through securitizations without retaining adequate capital against worst-case losses. The speed bump treatment of risk managers allowed these levers to be pulled farther and faster than prudent underwriting would have permitted. Stay with this story. The final consequence was irreversible for many stakeholders. The FDIC's sale transferred deposits and branches, but shareholder equity and the institution's independent franchise effectively vanished. Community ties were disrupted. Legal settlements and long litigation stretched for years. Public confidence in mortgage lending declined and had to be rebuilt through both regulation and market discipline. The human picture is essential to understanding the cost. Families who once celebrated quick approvals found themselves facing foreclosure. Branch employees who hit production targets lost their jobs. Investors who believed in the brand lost capital. Regulators who hoped to stabilize the system had to act under acute pressure to prevent broader contagion. Each decision to favor growth over guardrails cascaded into these outcomes. The lesson is stark and simple. When a financial dynasty treats its risk function as a speed bump, it removes the last line of defense between optimistic growth and catastrophic loss. Incentives that reward yes over prudence, funding structures that depend on continuous liquidity, and leadership that minimizes dissent create a predictable path from expansion to collapse. The collapse of Washington Mutual is not merely a story of bad loans. It is a forensic case study of how institutions convert governance choices into economic outcomes. Follow the timeline. Learn the warning signs. This was not an accident. It was the end result of deliberate choices about product mix, compensation, funding, and the role of risk oversight. The bank was seized. The banking operations were sold. The balance sheet footprint was gone. The human and financial costs persisted long after the headlines faded. The anatomy of that failure shows how a culture of saying yes and a strategy that treated risk managers as obstacles instead of guardrails can turn growth into insolvency.